Leading chemical entities with a strong hold over a range of chemistry processes have gained weight due to the running global theme of delinking supplies from China in favor of India. In our Ideas for Profit today, we'll discuss about Atul Industries Q1 earnings and see if it merits investors' attention going forward from here. Well, the Q1 sales declined by 37% year-on-year, chiefly on account of the weak performance in the chemicals segment in this quarter. Top line was weighed down by lower volumes sold due to plant shutdowns as well as lower product prices, also realizations due to the slump in the oil prices. Now, on the contrary, sales in the life sciences chemicals segment has stabilized after witnessing weak performance in the earlier 2 quarters that we've already witnessed. Now, sequentially, this segment sales grew 6% and segmental operating margins also improved to 18.8% as you compare it with the 13.3% in Q4 FY20. Now, Atul's gross margin improved 575 basis points year-on-year due to lower raw material prices. However, this gain was largely offset by higher employee expenses and therefore, EBITDA margin also expanded by 94 basis points only. Amal Limited, the microcap subsidiary's Q1 earnings reflected both decline in the oil derivative prices and the lockdown impact as well. Now, the company deals with basic chemicals and hence its sensitivity to oil prices, chemical prices is even higher when you compare it to the parent Atul Industries, which deals with specialty chemicals. Now, Amal caters to key basic chemicals required by Atul such as sulfuric acid, sulfur dioxide, etc. And more than 80% of Amal's sales flow into the parent company. Now, in the quarter gone by, Amal's revenues declined 49% year-on-year and that's due to the lower product price realizations as well. While gross margins were largely stable, EBITDA margins severely contracted due to operating deleverage as well. Now, operationally, Amal has been a turnaround story, benefiting from superior cash flows in the last 1 year that we've seen. Also, the company has reduced the debt by more than 50%, leading to a debt to equity ratio of 0.13. Now, encouraged by this, the company also mentioned that it is evaluating major capacity expansion also going forward. Having said that, Amal's stock trades at a premium to the average multiple for basic chemical segment, and this makes us cautious on that opportunity. Further, investors should note that the company disproportionately benefited from high prices of sulfuric acid and derivatives due to favorable demand-supply dynamics that we've been seeing for a long period of time. Now, due to commodity nature of this business, such advantage may not sustain for a long time as well. Now, for Atul, the life sciences chemical segment, as expected, is definitely witnessing a better performance due to the positive outlook for agrochemicals as well as the pharma end markets as well, especially in the current times. However, discretionary demand contraction is a major worry in the near term. Now, the company has a significant exposure to the end markets such as automobile, dyes, rubber, textiles, construction, which have all relatively weak prospects in the near to medium term. So that needs to be washed out by the investors. For global MNCs, the current crisis definitely adds to the growing theme of sourcing chemicals from India as an alternative. Additionally, large chemical players such as Atul Industries are better positioned to deal with the near-term hurdles that we are seeing right now. Also, with respect to operations, supply chain and working capital management, which can help them gain market share in the domestic market going on from here. Also, to capitalize this opportunity, the company is also investing 487 crore rupees in various capex projects. Now, once these projects are commissioned, we'll see that the aggregate sales potential would be say 5,400 crore rupees at 90% of the utilization. Now, among key projects to track are that of the subsidiary Atul Biosciences, 110 crore rupees investment in Ambernath towards the active pharma ingredients or APIs. Atul also plans to commission 195 crore rupees capex for the production of monochloroacetic acid or MCA by the end of the current year as well, and targets to meet the entire import dependent demand of MCA in India. Now, Atul Industries also presents a promising structural opportunity right now here. The stock has recovered sharply from the lows of March that we had seen and currently is trading at an expensive valuation of 18.4 times FY22 enterprise value to EBITDA. Now, hence, investors should actually or could wait for lower levels to really accumulate for the long term going forward from here.